Welcome back to Lunch at the Market. Something occurred to us today regarding the markets. If you rewind, say 6 months or so, certainly for most of 2009, there were very few days where the Dow did not move more over 100 points. It was quite exhausting, if you ask me, to see the market whip back and forth, driving the individual investor to the sidelines because they couldn't deal with the massive back and forth. In a way, the market is more efficient now than it has ever been because most of the weekends have been shaken out. Very few people left in the market really don't get it. Most of the market participants now are large institutions, professionals, or traders who trade for themselves. Regardless of whether or not the trigger pulling is being done by machines or humans, who, by the way, program the machines to trade while they're doing something else, that part doesn't matter. What has been really nice in the last 3 or 4 months is the reappearance of days where the Dow moves 30 to 40 points, or even less. That's right, the idea of consolidation, where the market hangs out along the even line while investors get in and out of the market and owners of stocks in it change hands. Those who are up enough to be happy or tired of waiting move to the sidelines or pick other stocks. Those who believe there's room to run or are changing into other names acquire new positions. When it's said and done, you end up with more owners who are committed to holding the stock long that you used to have. This consolidation of gains is what gives the market a base or strength that needs to continue higher as long as things like corporate earnings and macroeconomy continue to improve. What do you do today? Not a whole lot. We had a strangle in BIDU that we turned into an iron condor. How did we do that? We were long the 125 call and the 85 put. Both were way out of the money and would have seen a nice pop if the stock moved a bunch, but it didn't. So we sold the 120 call and the 190 put against our strangle. And we now have an iron condor where it's short November 90-85 put spreads and 120-125 call spreads. The only other thing we see out there is a call spread risk reversal that takes advantage of the decline in Bucyrus, symbol BUCY. As has been standard for us, we're looking at January 2012 to get long the 65-85 call spread and then sell the 60 put against it. There's actually a terrific premium in the options right now, so you can really play around with this one. As we've laid it out, you should be able to take in $2 per spread to put on this position. You could bring down the 85 strike or 80 or 75 if you want to take in more credit up front and not worry so much about the stock going up. You can also move the put strike down as well to lower your risk. For instance, if you own the 65-80 call spread and then short the 55 put, you can still take in $1.50 with even less risk, as the stock will have to fall below 53.50 before your losses start. That's $15 or 21.9% from here. It's a huge decline, and we are still planning for the world to look better in 456 days, not worse. Hope your week went well. As always, thank you for tuning in. We're taking the kids to fun on the farm tonight so they can have hay rides, pet animals, and all sorts of fun things that kids like. Hope you guys have something fun planned on this beautiful fall weekend. Enjoy the weekend of football, and we'll see you on Monday.